Welcome to the Academy of Commerce and Management. Today, we are going to learn about the Reserve Bank of India. First of all, what is Reserve Bank of India? Reserve Bank of India is the central bank or apex bank of India. As a central bank, RBI controls, regulates, and supervises the activities of bank and banking system of the country. RB was established in 1935 under private management and was nationalised by the government in 1949. Now, let us see the objectives of Reserve Bank of India. The first objective is to maintain the internal value of currency. The second one is to preserve the external value of the currency. The third objective is to ensure price stability. The next one is to promote financial institutions, and the last objective is to promote economic development. Next, we are going to see the functions of Reserve Bank of India. First function of Reserve Bank is note issue. RBI is authorised to issue currency notes in India. It has the monopoly of note issue as no other bank is permitted to do so. It also enables the central government to control the supply of money as per requirements of the economy. Second, Reserve Bank acts as a banker to the government. That is, it acts as a banker, agent and financial advisor to the government in the different ways, such as maintaining the accounts of the government funds, receiving money and makes payments on behalf of the government, giving ways and means advances to the government, issuing new loans on behalf of the government, managing public debts, undertaking foreign exchange transactions on behalf of the government, acting as the agent of the government, and advising the government on all financial matters. Third, Reserve Bank acts as the banker's bank. RB is called the banker's bank because every bank should have to maintain a certain minimum of cash reserves with RBI as a statutory obligation. It serves as a lender of last resort, and also IBI serves as a clearing house for commercial banks. Fourth, Reserve Bank of India serves as a lender of last resort, not only to the commercial banks, but also to discount houses and other financial institutions. Fifth, Reserve Bank controls the volume of credit in the economy through appropriate monetary policy. It takes steps to reduce credit in case of inflation. And finally, Reserve Bank acts as a custodian of foreign exchange reserve. RB maintains the reserve of foreign exchange and regulates their use. It has the responsibility to maintain the stability of exchange rate of the native currency in terms of foreign currency. Next, let us discuss about the monetary policy management of Reserve Bank of India. Monetary policy is the macroeconomic policy laid down by Reserve Bank of India. It refers to the policy to control the supply of credit or money in the economy. Its objective is to correct the economy's inflationary and deflationary situations. The monetary policy states the use of financial instruments under the control of the Reserve Bank of India to achieve the ultimate objective of economic policy, mentioned in the Reserve Bank of India Act 1934, which is to standardize magnitudes such as availability of credit, interest rates, and money supply. Reserve Bank manages monetary policy of the country with the help of various instruments. Now, let us discuss each of them briefly. First, monetary policy management instrument is the bank rate, the interest rate that the central bank charges commercial and domestic banks for lending them money is referred to as a bank rate. This rate has been matched with the MSF rate, and as a result, it changes automatically when both the MSF and policy repo rates change. The second one is Liquidity Adjustment Facility, or LAF. The Liquidity Adjustment Facility of the Reserve Bank of India assists banks in adjusting their daily liquidity mismatches. Repo, that is, repurchase agreement, and reverse repo are the two components of a liquidity adjustment facility. The third one is repo rate. The key monetary policy rate of interest is the repo rate or repurchase rate, at which the central bank or Reserve Bank of India RBI lends short-term money to banks, primarily to control credit availability, inflation, and economic growth. The fourth monetary policy management instrument is reverse repo rate. The fixed interest rate at which the Reserve Bank absorbs liquidity from banks on an overnight basis in exchange for eligible government securities under the Liquidity Adjustment Facility. The fifth instrument is open market operations. These include the outright purchase and sale of government securities for the injection and absorption of long-term liquidity. The sixth one is cash reserve ratio, popularly known as SCRR. The cash reserve ratio is a proportion of cash that all banks must keep on deposit with the Reserve Bank of India. The RB determines this proportion, which is changed by the central bank on a regular basis. The seventh one is statutory liquidity ratio, the percentage of NDT assets such as unencumbered government securities. Cash and gold is called statutory liquidity ratio. The next instrument is corridor. The corridor for daily change in the weighted average cool money rate is determined by the MSF rate and reverse repo rate, and the last instrument for managing monetary policy is the Market Stabilization Scheme. This is a scheme to regulate the excess availability of money in the economy in which the Reserve Bank of India withdraws surplus liquidity by selling government assets to banks and other institutions. So, that is all about today's class. Thank you for watching. See you in the next video. Stay tuned.